I want to jump right into this. 3 weeks ago, rates were 6.5, maybe even just a little bit less than 6.5. Look a couple of days ago, and it doesn't look like a 6 anymore. It looks dang near close to a 7 in what I'm seeing. So there might be many people out there just like me who are thinking, what in the world causes these rates to go up and down the way they do? So talk to us about the factors that affect mortgage rates.
Great question, and a very, very complicated question. But the easiest way that I think about it is just to understand that mortgages are a publicly traded commodity. Mortgages get bundled together in millions and millions and millions of dollars of mortgages get put together in a security that is then a commodity that can be traded on Wall Street. And it is the demand for that security that ultimately drives the price and therefore the interest rates that we're able to charge buyers when it hits the streets.
Now, I have heard that investing in mortgage-backed securities is considered a very safe investment, and it generally gets compared to investing in debt of the U.S. government. And I think there's some connection on what people will pay for bonds. Talk about that.
Yeah, the easiest way to monitor what might be going on in interest rates is to monitor the yield on the 10-year Treasury.
Yep.
So if you look at the yield on the 10-year Treasury, if it is creeping down, we would expect mortgage rates to creep down as well. And the opposite is true. If the yield on the 10-year Treasury is moving up, then we're going to expect mortgage rates to move up a little bit. The market really feels like 2024 and 2025 will be a year where we see mortgage rates decline.
Yep.
Right? What does that mean? That means mortgages that were funded over the last 24 months might very well prepay. So it's those prepayment speeds that are factoring into a lack of demand, because you don't want to invest in something expecting a return on your money over a long period of time if that investment cuts short by paying off early.
Wow, that was like a kind of a brain explosion for me as you said that, because I'm thinking, wait a minute, the fact that mortgage rates are likely to go down is temporarily keeping mortgage rates up. John, it is not uncommon for people to have federal income tax liens or state tax liens, and I would like to know, because so many listeners ask this question, how does that affect a borrower's ability to get a mortgage?
A federal tax lien is actually much more forgiving than a state tax lien. You can have a federal tax lien and still secure a mortgage loan. Now, there's some steps to that. We want to see that we've been making a payment, have established some type of payment arrangements with the IRS, and that payment history has been on time. So there's some things behind the scenes that get done, but it's still doable. Now, state tax liens are a little different. State tax liens can actually take precedent over our mortgage lien on the subject property. And therefore, get a state tax lien, we're really not going to be able to do a mortgage until that tax lien is paid in full.
My suggestion, and this is sort of my business philosophy anyway, is if you're avoiding having conversations with either the U.S. government or the state of Georgia over some kind of tax liens, my suggestion is get on out there and start those conversations, because at least you know what you're dealing with. And I know, John, you probably see the same thing that I do, is so many people show up and they're worried about something that they really shouldn't even be worried about, and they haven't investigated it, so they don't even know what they're worried about, but they make a bigger deal out of it in their head.
Not nearly as bad as people fear.
There's a lot of ways to work stuff out.